Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I'm Group News Editor for Logistics Management Magazine, as well as the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome back Avery Vise to our podcast. Avery serves as Vice President of Trucking for Bloomington, Indiana-based Freight Transportation Consultancy FTR Transportation Intelligence, a forecasting and data analysis firm specializing in freight transportation. Avery has closely studied the transportation industry for nearly 35 years as an editor, analyst, and researcher, including more than 20 years dedicated to the trucking industry. Avery served as Executive Director of Trucking Research and Analysis for Randall Riley from 2011 to 2013, after a decade as the chief editor of that company's publication, Commercial Carrier Journal. Prior to joining FTR in 2017, he held several positions related to the trucking industry, including serving as manager of public relations for Volvo Trucks North America, as well as being principal of his own transportation consulting and marketing research practice. Before beginning his involvement in trucking in 1998, he covered the commercial aviation industry for 13 years as a reporter based in Washington, D.C. Avery, welcome back to the podcast.
Thanks, Jeff. It's good to be back with you.
Absolutely. Yeah, I believe if I looked at it correctly, I believe this is your third time joining us here in the podcast. So that's great. And we're happy to have you. So why don't we just start at the top, Avery? Why don't we take a look sort of at how you're viewing um, the current state of the freight economy and sort of the factors that comprise that and influence freight, whether it be retail sales, GDP, recent Federal Reserve rate cuts. What's kind of cooking from a macro perspective as it relates to trucking?
Sure. The situation really probably best described as sort of solid, but not going very much in either direction right now. We have an industrial sector that's quite sluggish. That's reflected, I think, a lot in the fact that LTL has really not done a whole lot, after Yellow went out of business. That
Yeah,
really helped the overall sector, but you haven't really seen it go anywhere. And in fact, employment in LTL is basically where it was when Yellow went out of business. So you haven't seen any strength there. You've seen a big improvement financially because of that closer capacity. But for the rest of the industry, obviously, truckload being a big part of that. One of the big disconnects is when you look at the overall industry, overall economic data, and look at what's going on with freight, and you're trying to puzzle like why isn't freight stronger? Now, part of it is, of course, industrial production is a much bigger deal for trucking than consumer spending is. So that's
yes.
issue one. But issue two is that consumer spending is really not in the areas that drive truck freight. So, when you look at what's been driving what we are seeing, which is not tremendously robust, you see that the two big areas of strength for consumer spending is things involving computers, and a lot of that's even software, which of course has no freight footprint whatsoever. And the other is pharmaceuticals. And interestingly, computers and pharmaceuticals is sort of the strength not only in consumer spending, it's the strength in a lot of ways in the overall manufacturing sector as well. There's some other areas like automotive, which is kind of volatile right now, but is still relatively strong.
Sure.
And in international trade, if you look at recent international import data, and really dig down into it, the dollar value increases are coming from semiconductors and servers and other things involving AI and from pharmaceuticals. So I kind of like to say that if you look at the overall economy, it's being driven by artificial intelligence and Americans' anxiety over artificial intelligence.
Okay. Interesting. So when we look at sort of individually, we'll break out sort of truckload and then we'll do a less than truckload or LTL. How would you view sort of, and that was a great job of sort of setting the table for what we're about to jump into. When we look at truckload specifically, Avery, how would you describe it sort of? What was the year in truckload what was the year in truckload like in 2024? We hear a lot of talk that perhaps a freight recession, for example, is ending or has come to an end. Are you seeing that perhaps being reflected in the current state of truckload, or are there other factors at work, maybe?
I think the what I would describe 2024 as for truckload as basically stagnation plus, meaning
Okay.
that you through the course of the year it felt like there was very little change. Um, if you compare where we are today to where we were in January and adjust for seasonality, I think we are in a stronger position financially for truckload carriers. It's just been so gradual that I don't think it's felt that way. And it's really just a matter of we are seeing some improvement in some areas in the industrial sector and the consumer sector. And we've seen some sort of I would not say a drop in capacity, but certainly a fading away of capacity, perhaps. And when you
Hmm.
put the two together, it has put the industry in a stronger position heading into next year. But it is still not a strong year. We're not seeing um, anything that would be called robust. If you look at pretty much any indication of that, the spot market is doing very little that it didn't do last year. In the most recent data, the only thing that looks like it might possibly be inflecting is the refrigerated sector, which just in the last couple of weeks is outperforming, where it was last year. But overall, it's just been sort of a status quo, at least from the perspective of the actual provider. But again, if you look at where the industry is at the end of the year and where it began the year, it's an improvement. It's getting us there. Utilization has gone up. It is basically back to an average level by our estimation. Um, and will continue to improve as we see freight growth and as we see probably no real increase in capacity, if not some further declines in capacity. But those improvements, which have been several percentage points in utilization, have been sort of under the waterline.
Okay.
So they have not really affected rates in any sense at all. But it's a necessary move to get there. So I guess if I had to sum all of that up in just sort of one description, I would say a marginal improvement over the course of the year.
Okay, great. And what about things on the LTL side? And I know you had mentioned Yellow's exit from I guess a little over a year and a half ago, or a little less than a year and a half ago, or earlier in your comments. But how are things going on the LTL side, would you say?
Well, I mean, LTL pricing is a lot better than truckload pricing, largely because you don't have that capacity disconnect that you had in truckload, which, as I said, is sort of fading away. Um, but that's about it. As I said earlier, you look at payroll employment. It came down in the latest data, which is only through October. Most other measures show, activity being quite weak. It really kind of boggles the mind what might have happened had Yellow not gone out of business.
Hmm.
Had Yellow survived and what that contagion might have done, or whatever term you want to use, to the rest of the industry. Yellow going out of business was, probably saved a lot of other companies, but hasn't really done a lot more than that. And as we go forward, we're really going to have to see an industrial improvement. I mean, obviously LTL has done better over time in competing for retail with truckload, but in the current environment with rates and truckload as they are, that's just simply not in the cards for the most part. So as we look ahead, it really kind of comes down to getting some improvement in the industrial sector. One element of that is going to be lower interest rates, which will, if nothing else, encourage at least stronger inventories, which would at least generate some movement there. But we're still sort of struggling to see not only what the fundamentals are telling us, but anything really from the change in administration that might spur that. Obviously the goal of the tariff plans that we are hearing about is to boost domestic production, which obviously would be huge for both LTL and truckload. But getting from here to there is going to be very difficult if it happens at all, and it's certainly not going to happen over the next year. And if anything else, it's more likely that we'll see temporary disruptions in the supply chain and due to inflation. So the next year is going to be very interesting because there will clearly be some improvement in certain quarters just due to pull forwards because of tariffs and so on, which LTL will benefit from as well as truckload. But it's just a long sluggish period. Our forecast for industrial production is really that it recovers to maybe 1% growth next year, which is not particularly robust. It's better than we've seen the last couple of years, so at least it's looking up. But it's going to be a long haul, I think, for that
Okay.
sector.
Understood. And you had touched upon pricing when we had initially talked about LTL there. Well, can we talk about rates and pricing on both sides of the fence, if you will, for both truckload and LTL? What's sort of the vibe there? How are shippers approaching 2025 pricing, for example? And then maybe as a follow-up, Avery, we could just touch quickly on sort of the brokerage landscape. Certainly, it's been a tough year on that side as well. But I'll throw the ball back to you. You can kind of dice that up however you like.
Sure. Yeah. So, as we look at the rates, this year was not good from the carrier perspective. It was pretty good from the shipper perspective. So truckload rates overall being down, I guess 2 to 3 percentage points if you look at a blending of spot and contract based on 70/30 contract. This year we saw contract rates in truckload being down roughly 4%, I believe. Spot rates being down almost nothing. I mean, really just kind of on par with last year. As we
Hmm.
look at next year, our forecast is obviously recovery, with spot rates in truckload being up about 7%, which is okay. Nothing really to get excited about because usually in spot rates you want to see a much greater, upswing. And contract rates being up roughly 2% in truckload, which is nothing really to get excited about at all.
Hmm.
None of this really factors in all of the distortions that Trump administration policies might bring. So there could be some upward, I would put almost all the forecast risk probably to the upside on that, just due to whatever tax breaks we see, obviously changes in import timing and things like that due to tariffs and so on.
Yes. Okay.
For
Okay.
LTL, pretty sort of steady as she goes. Looking at rates being up, I think about 3% next year. Certainly not, I think, what the sector was hoping for. Um, but I think what the market is going to allow. We're seeing already LTL carriers as well as truckload carriers, trying to position for stronger gains. But I think shippers, because this lull period, whether you call it a freight recession or whatever you want to call it, has lasted so long. I think shippers have gotten to the mindset of they're no longer in the mindset of reacting to sort of logical expectations and more reacting to things they actually see in the market. Because, if you go back a year, a lot of people were saying, by Q4 of this year, we would have had a rebound, which clearly we
Yeah.
didn't have. And so I think there's a lot of lot of thinking there that it might not happen. And there are a lot of, there's some structural things happening too that I think are working uh, to shippers' advantages. Now, arguably, they could be to carriers' advantages too if they're managing themselves well. But because this is coming at a time when the shipper has the upper hand, it is, working to their advantage. And that is basically increasing levels of transparency over rates. So there's a lot more I think there's a lot more information, actionable information out there over what the actual market rates are in real time.
Okay.
And so I think because of that, you're seeing a lot more sophisticated timing of bid cycles and so on. And I think that's going to limit a little bit of the upside. Now we're still going to have cycles. We're always going to have cycles, but I think that we're not going to have that sort of normal market, if there is such a thing anymore, volatility to the degree that we used to have. So I think as we look ahead, it's still going to be sort of okay, I will give you a rate increase when it looks like the market is actually moving, not because, you're telling me that, this is going to happen and then this is going to happen and then I'm going to need your capacity.
Okay.
Um,
Got it.
and you mentioned brokers. I think what's interesting is, the broker market has obviously had some soft times as well, but the one thing that we have to keep in mind is that there has been a shift, I think, in overall transportation to the broker side of, a few percentage points at least, that is probably permanent. And that is really just a function of the shift in capacity from the large asset-based trucking companies to the one truck, two truck operations operating in the spot market. That has proven to be a lot more resilient than people thought. I think one reason why people thought we were going to be out of this recession already is that the expectation from a lot of people was that we would have lost, all of those carriers that we added during the, 2020, 2021, early 2022 period. And that has not happened. Yeah, we lost a lot, but we still have basically 36% more trucking firms in the market, most of which, of course, are very small, operating on behalf of brokers.
Hmm.
So, while the brokers had, some margin difficulties and so on over the last, couple of years, I would say, they still are well positioned, I think, over, for the longer term. I think we've seen a shift there that I think is long-standing. And as we look at, the carrier population changes, they've really stabilized, and it's hard to envision at this point a lot more very small carriers going out of business, in large numbers. And that represents somewhat of a shift. Now, that shift, of course, is happening sometimes within corporations that have asset-based carriers. So, let's keep that in mind. So some of this is sort of, intra-corporate, but
Yeah.
it is a shift of activity from, asset-based truckload into non-asset.
Okay. All right. Great. Great. And in terms of the incoming Trump administration, it's fair to say that, especially as it relates to freight transportation, the tariffs really are top of mind in terms of what could happen. And we're seeing the numbers. They've been pretty well recited at this point, 10 to 20%. Was the original plan, and then 60 plus percent on all imports from China, and then the uptick for the USMCSA partners, which I'm blanking on the actual percent right now. But in any event, how could these tariff actions impact the trucking landscape, as well as the increased traction, or at least momentum, that we're seeing when it comes to nearshoring or domestic production?
Sure. Well, there's a lot to unpack in that, and let's start with the near-term issue, which is the 25% tariffs that President Trump announced through a social media post on
Yes.
November 25th, and really we don't have a lot more than that to go on at this point as to what the intention are. But one thing that we do need to realize is that that was presented not as a ongoing policy. That was presented mainly as a threat or as a quid pro quo. In other words,
Hmm.
these tariffs are going in because of illegal immigration, because of illicit drug trafficking. And the China was brought in because on the illicit drug trafficking side, a lot of the precursor chemicals are presumed to be coming for fentanyl are presumed to be coming from China. Um, so that raises a lot of uncertainty over how this will actually play out, or even whether it will. Might we see some sort of deal cut between now and January 20th that means these tariffs never happen at all. But the
Yeah.
supply chain can't really depend on that. So we think that that is going to have the most near-term impact. It probably will not be dramatic because I don't see factories in Canada and Mexico gearing up during the holidays to produce a lot of goods for trucking companies to haul across the border. But certainly, an increased level we might see due to whatever inventory is sitting around in Mexico and Canada. That's probably going to be snapped up and brought across the border. And meanwhile, we saw just, I think, yesterday an explicit threat of a retaliatory tariff from Canada. So we might see Canadian firms do similar things. So, you know, that's kind of up in the air. It's obviously a huge deal because Mexico and Canada and China are the three largest trading partners. Let's go back though to the broader, tariff, the universal tariffs of 10 to 20%, the additional tariff on China, which was sort of what we were looking at during the campaign. So our expectation is that once we have a little bit more clarity over timing, that we will have some sort of pull forward, kind of like what we saw just this year regarding the anticipation of the port strikes on the East Coast and the Gulf Coast. Um, but this is not going to be like 2021. So the impact of that is probably going to hit international intermodal, but it's not going to, other than drayage, it's really probably not going to hit trucking all that much. And that's because the dynamic is very different than the last time we had a big surge in imports, which is in 2021. And that's because that was a consumer-driven demand. And we're not expecting to see that this time. So if you sort of game out what the impact for trucking is, you bring those goods to the U.S. ports, but then there's no real pressure to bring those goods to point of sale,
Hmm.
like there was in 2021 and early 2022. So the impact on trucking, I think, is a little less clear. Obviously, if the whole effort were to succeed in reshoring or nearshoring, although nearshoring seems to be not the priority given what we're already threatening our two largest trading partners with. Um, if we were to reshore, that's obviously a huge deal
Yeah.
for trucking companies, and also is an interesting dynamic for shippers. Because what I think it does, if and we're speaking theoretically here, because I think a substantial reshoring, if it happens, is years away. But if we do get a much higher level of domestic production, I think that takes a lot of the cycle momentum out of the trucking industry. You have a lot more sort of base level of activity that's going to occur. And I think for both trucking and domestic intermodal, you you have for the shippers sort of less downside, if you will, or less, I guess, upside. In other words, fewer lull periods for them to kind of take advantage of. So it would make for an interesting dynamic in transportation. But again, I think that would be years away if it
Yeah.
happens at all. It's more likely to just shift a lot of activity in 2025, where you have some quarters that might be very strong on in international intermodal and in drayage, and then some quarters that would be quite weak, kind of like what we saw in 2022.
Okay. Okay, got it. Just a couple quick ones to wrap up here, Avery, and one simply being now that we're approaching mid-December, to look back at the 2024 peak season. In your opinion, how did things go, or how have things gone for peak this year relative to other years? I only ask that because it's been very uneven or wobbly, even if you will, going back to the 2020 to the initial COVID year.
Sure. It's a lot of the data that you need in order to assess that, frankly, probably won't come out for another few weeks. But based on let's look at spot data, for example, which is probably one of the ways you can assess it in real time. This year has looked a lot like last year. The dry van, which is probably most affected by holiday shopping, what would be most affected. The dry van sector, both in terms of volume and in terms of rates, looks almost like a carbon copy of last year.
Okay.
So nothing really outstanding, but also holding up. And certainly we see that in the the retail sales figures that we see and so on. But like if we look at October, October is not a particularly strong month for inflation adjusted spending on goods. And to the extent it was in computers, which is great from, dollar value standpoint, doesn't produce a whole lot of freight. So I would say my assessment of this peak season is probably, it's sort of a meh year. Not
Yeah.
bad. We've seen worse, but certainly no real acceleration relative to last year.
Got it. Okay. And then just last question here, and we touched on a few of these uh how it could be answered, I guess, but when we look at 2025, it's coming up in a couple weeks. What would the outlook be from your perspective for trucking specifically?
Sure. So from the carrier perspective, 2025 should be a considerably better year. We expect contract rates to actually start rising fairly early next year, and certainly by Q2 is our forecast on a seasonally adjusted basis.
Hmm.
Uh, and uh, and so that improvement will begin for them. We're already sort of seeing that in the spot market. We are running fairly consistently higher year-over-year numbers on an all-in basis for carriers in the spot market, even stronger on a excluding fuel basis. So in other words, the fuel portion of the all-in rate is smaller than it was last year, which is good news for carriers. Although that is almost certainly going to sort of wither away because last year at this time we were seeing a sustained drop in diesel prices. So probably not a lot to gain there. But we do expect to see improving freight, and we do expect to see rate improvement. So certainly by this time next year, we expect carriers to feel much better. The real interesting dynamic, though, is, by the time we get to this point next year, um, assuming no dramatic changes in the EPA NOx rule, which I would say is not likely to change, but to some degree, all bets are off with the new administration and new Congress.
Hmm.
Um, we're looking at a pre-buy of equipment that needs to start then, and the real question is going to be, will carriers be healthy enough or feel strong enough to actually to buy that equipment ahead of 2027, or are they going to extend their trades out? Not nearly to the degree they did in 2010, when obviously they were in the bottom of the Great Recession or near the bottom, but certainly there's a lot of things that are kind of going on in the background right now involving equipment, looking at the pre-buy, looking at the used truck market. So I think equipment is going to be one of the real interesting issues in 2025. as opposed to the freight market, which we believe is going to be, steadily, although not dramatically improved.
Okay, understood. Great, great summary there. All right, well, look, we're at the end of our allotted time for today's podcast. So, Avery, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I'd like to offer up a big thanks for spending some time with us again. Your third time here on the podcast. So, to borrow a hockey term, the hat trick.
All right,
Yeah,
cool.
absolutely. And for those of you that are on LinkedIn, please feel free to go check out Avery there. He always has a lot of good posts. It's simply linkedin.com/in/Avery Vise and that's VISE. He always has a lot of good posts and a lot of good information there. And also, if for those of you on Twitter, please feel free to give us a follow simply at LogisticsMGMT. And please also go ahead and sign up to subscribe to our podcast. If you're not doing so already, just go ahead and look for Supply Chain 24/7 wherever you get your podcast. Thanks, everybody. Have a great day, and we'll see you next time.